Hi, welcome back. This is Adam Koo, and in this video, I'm going to show you how professional traders trade breakout patterns, one of the most common strategies traders use. So before we start, do read the risk disclaimer, pause the video. Once you're ready, let's begin. So, why do traders trade breakouts? Because breakouts have a very high probability of success when traded properly. First, let's look at a long breakout. What's a breakout pattern basically? A breakout pattern is when an uptrending stock breaks above a key resistance level. Once a key resistance level is broken, it means that excess supply has been taken out by new demand for shares. And that often leads to bullish momentum and the share price moving higher in the short term. So let's take a look at some of these charts. The first chart is a typical breakout pattern where you see the stock on an uptrend over here going into a small consolidation pattern. And a consolidation is defined as the price making the same highs. So it makes a high over there at about $38, makes the same high at $38, and makes the same high again. And a resistance level has to be tested at least 3 times to be significant. And that's one of the first rules you got to understand. So test once, twice, and 3 times. So it's making same highs over here and more or less same lows. So over here, the stock breaks out, which means that the price is able to get above that previous resistance level. And once it does, it begins its new uptrend. So we want to enter at a time to catch its bullish momentum. On the right, you see another typical breakout pattern. This time, the price is making the same highs again. 1, 2, 3. Again, it's going to be tested 3 times. Making the same highs, but making higher lows. So this forms kind of like a wedge pattern. It doesn't matter which one it is, works the same way. You see a breakout, price gets above that resistance level, and begins its new uptrend. And again, that's the precise time we want to enter to capture that upward momentum. Now, of course, it's not as easy as I just said, because many times beginners, they get caught into what we call false breakouts, where the stock looks like it's breaking out. The moment the amateur buys, it fails. So I'm going to teach you how professional traders avoid false breakouts. You can't avoid it completely. You're still going to have losses once in a while, but how do you greatly increase your probability of getting winning breakouts, winning trades? So to do that, let's look at some of the rules involved. So here are the specific rules that I use to look for high probability breakouts on the long side. So the first rule is you have to look at a stock when it's testing a resistance level at least 3 times. Okay, so over here on the graph, you can see it testing once, twice, and a 3rd time. So that's the first rule. Number 2, after the test of that resistance level, you want to see a full candle body opening and closing above that resistance level. So if you look at this candle over here, now again, it could be a bullish or bearish candle. I prefer a bullish candle where it opens here and it closes here. And the body of the candle has to be above that resistance level. So in other words, if the body was kind of like this, where it opened below the resistance and closed above, it's not as convincing as the entire body opening and closing above the resistance level. And if there's a lower shadow, the lower shadow can cut below the resistance level, that's fine. In fact, I prefer that, when you've got a lower shadow testing that resistance level. Next, many times traders would just take any kind of breakout. I only like to take a breakout pattern when the stock is already on a clear uptrend. Now, how would I know that it's on a clear uptrend and in a mini consolidation within that uptrend? Well, I use moving averages. I like to see the 50 moving average above the 150 moving average. That tells me that the stock is on a medium-term uptrend. Okay? At the same time, the 20 exponential moving average, 20 EMA, is above the 40 EMA, telling me that it's a short-term uptrend. So medium-term uptrend, short-term uptrend, temporary consolidation breakout. That's the best I'm looking for. Next, I also look at momentum indicators like the force index, the parabolic SAR, and the MACD with a 12, 26, 9 setting. And I want to ensure that at least two out of three of those momentum indicators are showing bullish momentum. The moment I've got all these factors into play, I know I've got a high probability breakout. So what I do is I place a buy stop limit order about 5 cents above the high of the breakout candle. So what's the breakout candle? The breakout candle is the first candle that breaks out of that resistance level. Again, I want a full candle body, right? And I'm going to place an order to buy 5 cents above the high of that candle. Okay? So why do I want to do that? Because the next day, if it fails and the price goes down, my buy order doesn't get triggered. My buy order only gets triggered if the price continues moving up, hence 5 cents above the high of this candle. Okay? So it's a buy stop limit order. So the moment it hits that entry price, it stops and enters at the market. But I'll put a limit to it where I would place a limit about 10 cents above that entry price. So once again, the entry price is 5 cents above the high of the previous day's candle. And the limit price is 10 cents above the entry price. The other thing that's really important is that sometimes when a stock breaks out of consolidation, it may be overstretched or overextended or overbought. In those cases, I don't enter the trade. So I want to ensure that the price is not overextended. Now, how would I know that? Basically, I want to see that the entry price is close enough to the 20 exponential moving average, at the same time close enough to the 50 moving average. When I enter the trade, I would attach a stop loss order, which is basically a sell stop order, 1 ATR. ATR is basically your average true range or your daily volatility. So I place a stop loss 1 ATR below that support level, and ideally that stop loss should be below the 20 EMA moving average. Ideally, okay? So again, let's look at a chart, the graphic, and you can see over here, it tests once, it tests twice, it tests the third time, and it breaks out over here. So I place my buy order 5 cents above that breakout candle. Okay? Now I call this buy point 1. Right? Now sometimes after it breaks out, it may come back and test that previous resistance that now has become support. So it doesn't always test it, but if it tests it, it comes back down again, okay, and it goes back up again, you could also enter over here. We call this buy point 2. So buy point 2 is entering on the pullback of the breakout as it tests the previous resistance that has become support. So some traders like to enter at buy point 1, some like to enter at buy point 2. I prefer entering at buy point 1 because buy point 2 doesn't always happen. Either way, it's up to you, but I'll focus on buy point 1. Now let's take a look at some examples. So here's a great example of a long breakout that meets all those rules with a high probability of winning, right? So we've got ABC stock. Sounds corny, but it's really called ABC stock, right? So it's in a consolidation within an uptrend, right? So over here, you see it making a high at 92.50. It tests once, it tests that same level twice, and it tests it a third time. Now notice that at this point, some amateurs would start buying because they think it's a breakout. Well, it's not a breakout. Why is it not a breakout? Because we don't have a full candle body above that line, right? It's not a full candle breakout. Now over here, you see a full candle body above that resistance level. So that is a breakout, right? Great. So that's our first criteria. Tested 3 times, full candle body breakout. Next, is it on a clear uptrend? Yes. You can see this red dotted line and the blue dotted line. That's a 20 EMA and that's the 40 EMA. So I want a 20 EMA to be above the 40 EMA on the breakout. As you can see, it is above, so that tells me it's on a short-term uptrend. Next, I want the 50 moving average, which is this blue moving average, above the 150 moving average, which is the green moving average, which tells me that it's on a medium-term uptrend as well. So short-term uptrend, medium-term uptrend. I've got a high probability that this price will continue going up. Next, I look at the force index, which measures volume, and the MACD, as well as the parabolic SAR. And you can see that upon the breakout, the force index, or this black line, has gone above 0, which tells me that the force is strong, the force is bullish. That has to happen. I also notice that the MACD is bullish, where I've got the black MACD histogram with the black MACD line crossing above the red signal line. And not only that, but the parabolic SAR is below the candle, telling me that it's a bullish momentum. So I've got 3 out of 3 indicators telling me that, hey, it's bullish. What else do I want in life? Nothing else. It's a high probability trade. I'm going to take this trade. Great. So I put my buy order, stop limit order, buy stop limit order, 5 cents above the high of this candle, somewhere around here. And the stop loss order, 1 ATR, average true range, below the support resistance level over there. So this is the risk which I'm taking. I call that 1R. Now the next day, what happens? The next day, the candle opens and closes above this candle, 5 cents above. So my buy order has been triggered. So notice that if it went down, it's a false breakout, I don't get triggered, right? That's why I use a 5 cents above. So it gets triggered the next day, and sure enough, I'm in the trade, it goes up, I'm making money. All right, let's take a look at another example. This example is on ULTA, ULTA. So once again, I've got a test 1, a test 2, a test 3. 3 tests, okay? Now, I have a breakout candle over there. That's a breakout candle, okay? I've got my 20 EMA above the 40 EMA, the 50 moving average above the 150, short-term trend up, medium-term trend up, great. My force index is above 0, as you can see over here. And I've got the parabolic SAR below the candle. So I've got 2 out of 3 momentum indicators that are bullish. So I'm going to put a buy order. So I'm going to put a buy order 5 cents above this breakout candle, right? So I place my order there. Now what happens the next day? The next day the price stalls. It doesn't continue going up. It goes sideways. So what happens? My order doesn't get triggered. So I cancel the order. I'm not in the trade. And sure enough, the price comes down, okay? And it goes up again. So this time I've got a second chance. It breaks out again over here. That's the second breakout candle. So this time I do the same thing. I put a buy order 5 cents above the candle, and the stop loss 1 ATR below that support resistance level. Now this time it succeeds. The next day the price continues going up 5 cents above the high. It triggers the order. Boom, I'm in the trade. It goes up, and I'm profitable again, right? So the first order was not triggered, the second one was triggered, and that's the beauty of this system. Now, a variation of this long breakout is what I call the counter trend line breakout, where the price is on an uptrend, but making a short-term counter trend resistance. So what it means is that, see, on an uptrend, the price is making higher highs and higher lows, right? So it goes like that. It's an uptrend, higher highs and higher lows. Okay, so that's an uptrend pattern, right? So sometimes what would happen is the price goes up, impulse, retracement, impulse, and what happens is that as it retraces, it goes into a wedge pattern where it makes lower highs. Okay, so this creates what we call a counter trend line, because the main trend is going up, but the counter trend is going down, so it forms a resistance level. Okay, so on one hand, the moving average is supporting the uptrend. On the other hand, the counter trend line is resisting the price. So it kind of like the price gets wedged in there, and when the price breaks out of this resistance, it tends to continue its trend. So here's an example of this pattern in action. Again, we've got a very clear uptrend. The 20 EMA is above the 40 EMA, which shows you as a short-term uptrend. The 50 moving average above the 150 moving average, medium-term uptrend. So it's a clear uptrend, but what happens? On the uptrend, the price is making, that's right, lower highs, lower highs, lower highs. And it has to be tested once, twice, and 3 times for it to be significant. Okay, so the price being compressed. So what happens? That's right, we have got a breakout candle over there. That's my breakout candle, beautiful little boy. Okay, and I've got 2 out of 3 indicators bullish. I've got my parabolic SAR, I've got my force index that's bullish, I've got my, well, MACD is still bearish, so I've got 2 out of 3. Once I've got a breakout pattern, notice it's still close to the 20 EMA. It's got to be close to the 20 EMA. I put my buy order 5 cents above the high of this candle, and my stop loss 1 ATR below this resistance level, which is somewhere over here. So the next day it gets triggered, it comes down, doesn't hit the stop loss, right? It's far enough for that volatility, okay? And then it then continues in the uptrend, making a profitable trade again. Here's another example of a counter trendline breakout, okay, on Apple. So once again, you see that clear uptrend with the moving averages. You see a test 1, a test 2, a test 3. I've got a breakout over there. That's my breakout pattern. I've got my force index, which is above 0, bullish. My parabolic SAR, bullish. Okay, I place my buy order 5 cents above that high of the candle. A stop loss is going to be somewhere here, and it gets triggered, and I ride the new trend as it goes up. So that's exactly how I play this strategy. Now, a very common mistake that amateurs make is that the moment they see the price breaking out of the resistance, they buy, and they wonder how come it comes down, hits my stop loss. Common reason is because they buy on overextended breakouts. Okay, what I mean by overextended breakout? Okay, you see, if you look at the price of a stock, it doesn't go up in a straight line. Okay, it's got to kind of like goes up, comes down, goes up, comes down, goes up, comes down, goes up, comes down. It's kind of like this person has to run, rest, run, rest, run, rest, so on and so forth. So when you see, for example, a case where, let's imagine this is a resistance level, there's a support, and the price is test 1, test 2, test 3, right? And the third time, what happens is that you see the price going up in a series of bullish candles like that. So, for example, you've got 4 or 5 days of bullish candles, and it breaks out over here. Now, many amateurs would buy here, and after they buy, what happens? The price springs back down again, and they lose. Why? We call this an overextended breakout. In other words, the price went up like too fast without taking a rest. So if you see a series of bullish candles without any consolidations, that's a very risky breakout pattern. Okay, so here's a good example. If you take a look at this consolidation, you may say, hey, test once, twice, 3 times, 4 times, and it breaks out here, right? So a lot of amateurs would want to buy over here. Now, I wouldn't buy here because, again, the price is overextended. When the price has gone up in a 90-degree angle, it is bound to snap back, right? So sure enough, what happens if you had bought there? Let's take a look. Right there, there you go, see? The price goes up, overextended, pump, it snaps back. Doesn't succeed, okay? So instead of seeing the price going up like that at a 90-degree angle, I want to see the price going up in a series of bullish and bearish candles like that. Goes up, comes down, goes up, comes down, goes up, comes down. So it's kind of like up, rest, up, rest, up, rest, up, rest, breaks out. It's rested, it's got room to run. Okay, that's what I'm looking for. Now, if that's very hard for you to visualize, then here's a very simple way to look at it. If the price is at that breakout, if the price is too far stretched from the 20 EMA and the 50 moving average, don't buy it. Because the moment the price is too far away from the moving average, it is overbought. You'll tend to snap back to the moving average. You can see that over here, if you had bought it here at this breakout, for example, no, in fact, sorry, it's worse than that. If you look at this breakout candle, you would have bought it here, right, 5 cents above. And you can see that it's very far away from the 20 moving average, which is the red dotted line, and the 50 moving average. When the price gets too far, it tends to snap back. Always remember that. So ideally, when you enter a breakout pattern, the price should be hugging the 20 EMA and less than 1 ATR away from the 50 moving average. Okay. Here's another example of overstretched. Again, you can see that this is Lockheed Martin. Tests once, twice, 3 times, breaks out here. All right, you can see this is a breakout pattern. A lot of amateurs would buy here. No, you can't buy here. Why? The price is too far from the 20-50 moving average. Sure enough, after you buy, it snaps back to the moving average, hits your stop loss, and you get taken out. Okay? You don't want that to happen. You want it to be hugging the 20 moving average. And let me show you an example of one that's hugging. So in this case, if you look at Nike, this is a nice breakout, right? Test once, test twice, test 3 times, test 4 times, test 5 times, okay? More than 3 times is good enough, okay? Now it breaks out. Look at the breakout. This is the breakout. This is the breakout candle over here. Can you see that this breakout candle is very near the 20 moving average? Can you see that? It's hugging it. That's what we want. So the price can extend, okay? That's what we want. We do not want this one, okay, where the price is very far from this 20 moving average, okay? And as you look at more and more charts, you get more and more experience, you can tell when it's too far away. This is another one that's not too far away. Again, ABC, test once, twice, 3 times. Notice that when it breaks out over here, all right, notice that candle is hugging the 20 moving average. It is not overbought, and so it has got the energy to keep running. And that's how you avoid overextended breakouts. Okay, so I've taught you how to enter a breakout trade. Now, when do you exit and take your profits? That's even more important, okay? Now, there are 2 exit strategies that you can use, either or, it's really up to you, right? The first strategy is to ride the trend and only exit when the short-term trend has reversed, okay? And how would you know? Simple, look at the 2040 exponential moving average, or the red and blue dotted line, which I showed you earlier on. So the exit rule is very simple. You exit the long trade when the 20 EMA crosses below the 40 EMA, or when a trending support is broken. Now, what does that mean? So in this case, you can see ABC, the stock which we saw just now, and this was our entry point. It broke out over here, okay? And it started this trend. Now, you never know how long a trend is going to last. It could last for months, weeks, even years, right? So you want to ride the trend to the end, okay? So when does the trend end? Over here. You see when the 20 red line crosses below the 40 blue line, it tells you that this uptrend has ended and is the beginning of a new downtrend. So that's when you exit at 112.5. You would have entered at about $95. That's a pretty good profit factor. Okay. Now, some of you may say, but the price went up to $120, right, over there. And by the time I exited, it was 112. I already, lost $8. Well, you can't get out at the top. You never know where the top is, right? As long as you get out and make money, hey, that's good enough, right? But you could have actually exited a bit earlier as well. And the way to do it is by drawing trend lines. So as the price goes up, notice that the price will go up, come down, go up, come down, right? It makes these low points, we call them pivot points, right? So do you notice that this is a pivot point, pivot point, pivot point? Can you see these pivot points, right? So when you start to see these pivot points, you can draw a line connecting these lines, right? We call this a support level. Now, the moment the price goes below the support level, which is in this case over there, it breaks below the support, you could exit here as well. So this would have been an earlier time to exit. So that's another strategy that you can use to exit your trade with a profit, okay? So that's the first option. The second option is a fire and forget strategy, which is the moment you enter the trade, place a stop loss, and if your stop loss is $1 away, put a profit target $2 higher. So you're risking 1 to make 2. If your stop loss is $2 away, put your profit target $4 away. Again, you always risk 1 to make 2. So in this case, we entered at this price. And let's imagine we had put our stop loss, we had placed our stop loss at say $95, to keep it simple, $95, right? And our stop loss was at $91. Okay. So what's the risk we are taking if we were wrong, right? Our risk would be $4, right? Our risk is $4 per share. So for every share we buy, we would lose $4 if it went down and hit our stop loss. Okay? So we have to make sure we make at least double that to make it worth our while. So if we are risking $4, our profit has to be at least $8. Make sense? So we are going to put a profit target at $8 above the entry price, which would be 95 plus 8, that will be $104, somewhere over here. So it simply means that once we enter the trade, okay, the moment it hits 104, we get out. That's it, simple as that. We either lose $4 or we make $8. This is what we call the fire and forget strategy. Now think about it. If you do, let's say 20 of these trades every month, or 10, whatever it is, right? And now I'm not saying that you're always going to win. You're not going to win all the time, but you're going to win at least 60 or 70% of the time. But let's be really conservative, and let's say you only win half the time, right? Now, if you win half the time, you would get 10 winners and 10 losers. True? Now, each time you lose, say, $1, okay? So you lose $10. But each time you win $2 because your profit is always double your risk, right? You win $2. So $2 times 10 is $20. And $20 minus $10 is $10, which is a profit. So this shows you that if you set up your trades properly with the right stop loss and the right profit target, and assuring that your average win is more than your average loss, even if you're right half the time or less than half the time, you're still making money. And that's the secret of how I make money consistently as a professional trader every single month, and how I help my students do the same. So I hope you've learned something from this, and I hope that you've enjoyed this lesson. If you've got questions, you can send me an email. If not, you can visit my website. I'm Adam Khoo, and my email is adam at akltg.com. Send me an email if you've got questions. I'll be happy to help you. If not, happy trading, happy profiting.